All right. Hello, ladies and gentlemen. My name is Greg Michalowski from forexlive.com, and this is my monthly webinar with FX Street. So I'm happy to be here. Today's day is February 26, 2015. Before we get started, let me remind everybody that trading foreign exchange carries a high level of risk that may not be suitable for all investors. In addition to that, leverage creates additional risk and loss exposure. Should you decide to trade foreign exchange, carefully consider your investment objectives, your experience level, and your risk tolerance. You can lose all or part of your risk capital, so be aware and be prepared. All right. A little bit about myself before we get started. I've been working in the financial markets now for about 28 years, 15 years in the institutional side, trading at Citibank and CSFB. Last 13 years spent at FXDD, and the first 6 to 7 years was mainly focused on the risk management side, so more on the trading, and then the last 5 or 6 years as a Forex analyst for that firm. I'm author of Attacking Currency Trends. You can find it on Amazon, or you can go to my website at attackingcurrencytrends.com. One of the highest ranking books, I'm proud to say, on Amazon.com as far as Forex trading that is. But with 4.7 stars in both London or in the UK, Amazon, and the US. So did something right in that. And also, but since September of 2014, I'm the director of technical analysis and trader education at forexlive.com, which I love, and brings me here. So happy to be here with you all, spend an hour or so. Another more commercial here before we get started. If you want to subscribe to our YouTube channel, I do videos there. You can go to query Forex Live, and you'll find our YouTube channel there. So be sure to do that. And also for daily commentary on foreign exchange. This is one comment that I did this morning. About the euro versus US dollar. You can always visit us at forexlive.com. Let's take a quick look at the market here before I get into my program here, because the market was kind of moving around, wasn't it? Where are my charts here? Let's see here. There we go. I just want to take a quick look at the euro versus US dollar. We've moved down below this bottom side trend line. That was our next target. We came down to that in the last hour, and then bounced off of that level and held up here against the prior lows. We've been in this non-trending range here for a while. So the ability to hold against this prior low right here is somewhat encouraging for the bears here, and it's keeping the bearish bias intact for the euro versus US dollar. I have this level here, 112.09. 112.09. I'm currently trading 112.17. 112.09. Let me see what the range here for the day is. The range for the day is about 164 pips. We get down there, it'd be about 170 pips. That's pretty big trading range, but we've been in a narrow trading range here for a while. Anyway, what's the importance of the 112.09 level? I need to go to the monthly chart, take a look at the low to the high right here, and the 61.8% retracement comes in at 112.09. Now we've been below that 112.09 level now for or through let me go back to our hourly chart. We went below the 112.09 level on these days right here. That was it. You know, a quick move to the downside, and then a quicker move to the upside, or just as quick move to the upside, and did it again here. So the movements below that 112.09 level have been fairly short-lived, but certainly the dollar bulls are taking control, especially against the euro versus U.S. dollar in trading here today. The other currency pair that's moving, dollar yen's really not doing that much, is it? Although it's following the dollar move to the upside, but we're still within this trading range here for the dollar versus yen. The other currency pair that's just moving here is pound sterling. We went up against the topside trend line here. Found early sellers against that topside trend line, and fell below this line right here. And as the New York traders came in, things started to unravel here, and the euro really led the way. But the pound versus U.S. dollar is also moving sharply to the downside as well, below the 100 and 200, below all All this what I thought would be congestion support, not to be. So the dollar's getting much stronger here. I thought I'd start with that. Why? Because markets are moving. I appreciate anyone coming in here today, but because most of the time that I spent here with you in these for FX Street is more on an education side. So I'm going to talk about trading. Oops. Trading, how to trade key events and releases. Okay, there we go. Let's start all over. All right. How to trade key events and releases. And today's data really doesn't fit into that mold because we had a lot of data. I'm kind of focused a little bit more on those one-off type of events like employment, like employment statistics in the United States, like interest rate decisions by central banks. Those are like key events and releases. And a lot of times retail traders focus on key events and releases, looking for that quick win. Okay, but I always like to warn everybody about what is the risk. It's always too many traders look at the rewards and they don't focus on the risks. And at best, if you go into a key event and release like the unemployment number, like a key interest rate decision, at best it's a 50-50 bet, isn't it? Most of the times the wins don't equal the losses. If you went into into all events and had a position on, I bet that a lot of you or a lot of traders in general, maybe not you, but a lot of traders, of course you guys are much better than that, but a lot of traders would think that, or if the market went their way, they would get out pretty quickly. Why? Because of the thrill and the adrenaline of the win, and it's like, yes, I won. I went through all this risk, I had all this anxiety, and boom, I'm going to take my profit really soon. And they take it really soon. And whereas if the loss, tell me if you feel this way, if it goes against you and the market spikes to the upside or the downside against your position, you kind of freeze. You get really fearful. You tend to do the wrong things in both on the win side and the loss side. On the win side, you tend to like, wow, take your profit as fast as you possibly can. And a lot of times you get those fills. On the losses, you delay a little bit. You don't know what really to do. Fear takes over, and either you're selling the dead bottom or you're doing something wrong most of the time. That's the way I feel. Anyway, it's not really the point of this. So what is a viable strategy for trading key events and releases? And the way that I focus on it is that you have to do your homework. You have to do your homework. And also understanding that trading after the details of the event are known is often the least risky and the best scenario for you and your account balance. After all, we don't want to be betting red or betting black if you want to be a trader. To be a trader is not about rolling the dice and hoping that it comes out snake eyes or whatever, however, or spinning the wheel and hoping it comes out black or red. That's not what a trader is about. A trader is much more than that. If you think that's what it's about, you're gonna go into the trader graveyard. I can guarantee you that. So smart traders who are focused on the long run, on being able to defeat the market, to defeat the odds that are quote unquote against you. Really, the odds are against you because you make it that way by betting red or betting black and not being a trader. But if you want to defeat the odds, if you want to be one of those traders who actually makes money, then you have to do your homework. You have to understand the risks of the events. You have to understand that perhaps trading after the event is the best case scenario for you and your account balance. And if you start to think that way, I think you'll be better off. You may miss some moves, okay? But I like to say there's always another trade, okay? There's always another level with less risk when you're more comfortable and all. But you may get, excuse me, that was like caught in between a cough. You may catch a lot of these moves because off a key event, you did your homework, you were aware and you're prepared, and that gave you the confidence to move forward and to execute smart trading. So what do I mean by homework? What do you have to do in your homework for a key event and a key release? Well, first you need to understand the market expectations. All right. We all trade off of what the market is expecting, not what you're expecting, but what the market is expecting. And I quite honestly give the benefit of the doubt to all the economists who sit out there and put out their expectations for things like non-farm payrolls or interest rate decisions. I mean, I do have an idea or a bias, but as far as economic data goes, non-farm payroll, I assume they have all the econometric models to put the numbers in and figure out the uh, what the non-farm payroll will be given all this other data that they plug into their models, and they come up with 230,000 or something for things like non-farm payroll. Interest rate decisions are a little different. We're looking at the same numbers at the Fed, but we try to get in their minds, try to listen to what they say and stuff like that. But all that goes into the same pot, understanding what the market expectations are. Okay, so that's number one. Then you need to define bullish and bearish scenarios, and then you need to define price targets for each scenario. And that is your homework. That is your homework before an unemployment report. That is your homework before a key interest rate decision or a key speech by a Fed official or an ECB official or wherever you think that the market is working up to a frenzy and there's enough uncertainty that the potential exists that we're going to get a pretty big move and a pretty big a trend-like move as well. So let's talk about the homework steps in more detail. Step number one, understand fully the market expectations. All right. For a central bank interest rate decision, what should you know about a central bank interest rate decision before the event? Well, are they going to change? What is the expectations for a change? Is it going to be a change or no change? All right. And so that's a base scenario. Are they going to change interest rates, or are interest rates going to remain the same? Boom. Statement expectations. A lot of times in this day and age, we get down to the words. Is the Fed going to take out patience in the next statement? We know that they're not going to raise rates. We know that they're not going to lower rates. That rates are probably 100% likely to remain unchanged. But will they take out the word patient in that statement? If you don't know that, you're at a disadvantage, aren't you? Obvious. You need to do your homework. Economic projections. A lot of times in these reports, the Fed, I know for sure, the Bank of England, no, they don't give out anything at all during their interest rate statement. I wish they would change that policy. But the ECB is starting to become more, we know that the ECB has a decision. Then we also have Mario Draghi talking in his press conference. So economic projections or comments and economic projections from the central banks. What are they expecting? What should we expect? The Fed has a thing called the central tendencies that they report every other meeting, and that gives tendencies for inflation, GDP, employment. And so, having an idea of what the expectations are for the market for that is important for your decision. Future policy actions, if the Fed is going to remain on hold and they take out patience, what are you looking for? What is the market looking for as far as future policy actions? Be prepared for something there. Just understand the whole thing. Let's focus a little bit on something like the U.S. employment report, which is what I'm going to focus on for the remainder really of this webinar. But the things like the employment in the U.S. employment report or any other employment report, there are certain pieces of data that come out within that report that it's important to understand. Non-farm payrolls, employment rate, average hourly earnings, participation rate. And using as an example the last employment report, because we actually, we had a surprise in that employment report, and I want to use that as the base case for this discussion here today. The estimates for the non-farm payroll were 230,000, 5.6, 230,000 increase, a 5.6% unemployment rate. The average hourly earnings were expected to rise by 0.3, and the participation rate was expected to come in at 62.7. Now, that's what I call my benchmarks. Those are the base case scenarios. Those are the expectations. That's what the economists have projected. And again, I give the benefit of the doubt to the economists, whether or not you do or not, doesn't matter. But we all look at those expectations and we base a judgment on that. And I think, by and large, it's what the market expects. And so the market's going to, let me put it this way. After it, if they're expecting 230,000 jobs and we get 300,000, it's going to be higher than expectations. If we get 250,000, it's going to be higher than expectations. If we get 210, it's going to be lower than expectations. If we get 220, it's going to be lower than expectations. The 230 is the number, okay? And so I believe that number, and I expect a reaction off of these base case, these benchmarks for these that data. So that's the information that I'm focused on. That becomes my benchmark. That becomes, I want to be in, very intimate with those numbers, okay, and understand that those are those, and if you have to write them down on a piece of paper, write them down on a note card, have them down on a note card, okay. Make sure you understand what the expectations are. So the trading bias, bullish or bearish, will be determined after the numbers are known, compared to the benchmark, right? So if the numbers are stronger than expectations, that's going to be what? Dollar bullish. If the numbers are weaker than expectations, that's going to be dollar bearish, right? And so that benchmark becomes your basis of bullish or bearish. It just makes obvious sense. So that's step one, understand the expectations. Step two in your homework assignment is to create a bullish and bearish scenario, okay? Now this, when I say create a bullish or bearish scenario, it implies that it's going to be a more a surprise, okay? If non-farm payroll is expected 230 and it comes out 225 or something like that, that's not really a case to be more bullish or bearish, okay? But if there is a material difference, then that's what you want to define in a bullish and bearish scenario. So some of you may ask, why both bullish and bearish? Why can't I just be looking for a more bullish scenario or a more bearish scenario? I think going into the last employment report, most people were thinking, the number was expected to be 230,000. What I heard through people before the event was it's going to be weaker than 230,000. Everyone was looking more toward the weak side, and I think whether that's human nature because the numbers have been strong, were much stronger the month before and the month before that. And so you expect that slowing of the trend, or, whatever the case, but it seemed like everyone was more bearish. And so that may influence your trading mind. But into a key event and release, you have to take those influences out of your mind and understand that I don't care what the number is, whether it's more bullish or bearish. I just want the number to be off of the expectations. And that's going to give me the best opportunity for a trending market. And trending markets, folks, are where the most money is made. It's also where the most money is lost because trends are fast, they're directional, and tend to move in larger trading ranges than what is normal, okay? And so if you can catch a trend, not only are you going to make money fast, it's going to be directional in the way of the trend, and it's going to be a larger trading range. So you're winning. on that. The opposite can happen as well, and that's why traders lose the most amount of money in trending markets. Why? Because that's directional tend to move larger than you think, and so traders will lose a lot of money if they're trading against the trend. But what we're trying to do in a key event and release is to get these bullish and bearish scenarios that are going to force the market to trend either to the upside or to the downside. That are going, and that's going to give us the opportunity after the event. Get it? After the event, after the risk of the black and red bet. Okay? So anyway, put your ego aside. Be honest with yourself. We might think that we know what the number will come out, but we really don't know. A 50,000 or 100,000 off in either direction can start a trend in the currency markets. Trends give the best opportunities to make the most amount of money. And trends can be identifiable as well. You can within a trend, you can see tendencies that that are really plain to see, that are easy to see, or that define your risk and limit your risk, and they're kind of easy to see. And we'll go through what I mean by that a little later. So bullish and bearish scenarios, and I'm going to focus on the euro versus U.S. dollar. So if you have a bullish scenario, so a weak employment report, set the standards, set the the benchmarks for a bullish scenario. So if we're expecting 230 and non-farm payrolls less than 210 with an estimate of 230 and 2-month revisions are negative. So some combination of the non-farm payroll change, that would be negative, okay, with non-farm payrolls. And we know that these 2-month revisions are becoming more important, aren't they? They're an influence, and they tend to be fairly large of late, or potentially. And so you have to be aware of not only non-farm payrolls, but the 2-month revisions. There aren't any estimates for the 2-month revisions. That's why I didn't include it in your benchmarks, okay? But you have to be aware and prepared that the revisions are an important part of the release, okay? The unemployment rate rises to 5.8%. The estimate is 5.6. Average hourly earnings. We know earnings were key last month. If they only rose by 0.2 or less than 0.2, that would be more bullish for the euro, bearish for the dollar. And if the participation rate remains steady or lower at 62.7, it's near the lows, that would also be more bullish for the euro, and it would be a weak employment report. So the combination of that was and I wrote this on the website as well. That's why I'm using it, okay? That a combination like that would be something that I would expect that there's a good chance that we have a trend-like move in the euro, okay? And what would be the bearish case for the euro? So a strong dollar and a strong employment report. And that would be if non-farm payrolls rose by 250,000 and there's 2-month revisions are positive, okay? Unemployment rate, and fairly decently positive. I'm not talking about 10,000 or 5,000. You get what I mean, all right? We need to have the surprise. Unemployment rate steady or lower than 5.6. Average hourly earnings greater than 0.3%. Participation rate greater than 62.8. Okay, so those are the benchmarks for bullish and bearish. So we've done our homework. We understand what the expectations are. So in step 1, step 2 is understand. All right, what are my bullish and bearish scenarios? Okay, smart traders do this, folks. You need to be a smart trader. All right, there is actually a third scenario. We know that there's a bullish scenario, there's bearish scenario. And the third scenario is a mixed or an expected report. And in this type of market, or that type of scenario, you can expect choppy and less trending markets, and those are yuck. That's not what you look for. That's not what if you get an as expected report, don't do anything. Just sit there. Just watch it. Almost even turn the screen off and go back and start on Monday. Lament the fact that you didn't get the trend type of opportunities. It is what it is, okay? There's plenty of opportunities within the year to make money off of key events and releases. And if you don't get it, Don't force it. Don't force it. Or be patient. Okay. Treat it like a normal day after that. But understand there's going to be some anxiety. There's probably going to be some extra choppiness as a result of the as expected report. So you have to keep that in mind. So be patient. Wait for levels that are going to make more sense to you, where you can define risk and limit risk. But really, I don't want to focus on that much today. But I'm just warning you: don't force it if the numbers come out as expected. So if you have a bullish or bearish scenario beforehand, you will be more prepared to anticipate and then trade a trend. More prepared to anticipate and trade a trend. If you can anticipate something, you have a much better chance, hello, Dad, to trade that trend. If you anticipate something, you have a much better chance to trade that trend with more confidence and to get on that trend. If you don't anticipate in your trading, if you find yourself reacting rather than anticipating, especially during key events, you're going to be slow to the market. You're going to be unsure. You're not going to be confident. You have to be anticipating. The only way to anticipate is by preparing beforehand, by understanding what the expectations are, by understanding your bullish and bearish scenario, and then now you're ready. Now you're ready. And so it is imperative that you do your homework. And the important thing is because it allows you to anticipate. It allows you to get in on a trend with confidence. And that's most important in trading. Think of it, I like to use the parallel with athletes, okay? And whether you're playing, let's say, baseball or soccer, okay? The greatest athletes in the world, they have skills, they have athleticism, but they also anticipate. They anticipate what that winger is going to do, if they call them wingers or whatever, I don't know, soccer is going to do. They anticipate a curveball because the pitcher in baseball, because the pitcher got them out on curveballs the last 2 times at bat. And so now they're anticipating a curveball. And that's what differentiates them from the also-rans who are just guessing, who are just up there without doing their homework, without understanding. And so it is athleticism, yes, but they take it to the next level by their degree of anticipation, All right, step 3, map out the bullish and bearish expected price moves. Map out, what do I mean by that? My goal by mapping out the expected price moves or targets along the way is to look at a chart with my own eyes, my senses, my eyes. What do I see? And see logical target steps in each direction from the current price area. I want to target what the next step is, what the next step is, what the next step is. And I'm not talking about going from 113 to 118, okay? That's unrealistic. That's not going to happen today. That's on the day of the event. You need to anticipate the next 24 pips and the 50 pips and the 70 pips and work your way up to where a normal trend-like day might go. And I'll talk a little bit about that a little bit later, how to determine what is a normal trend-like day or even a normal day, okay? You have to do that by looking at by targeting steps. If I see the steps or the targets using logical, visual tools and price levels, others from around the world will also see those targets. And I want to trade where the smart people are looking. The smart traders, this is the most logical thing. The smart traders, they're looking at the same charts. They're anticipating where it might go and how it might go, okay? And because how it might go and where it might go is going to give feedback to the market's acceptance of the trend. If everyone is in agreement then that the price is going higher or lower, then we should get below this level. We should get below this level. And that feedback is important for your confidence, and also it tells you about the trend. Remember, I said trending markets, they tell you things. They tell you that it's trending by doing certain things, by breaking a target level and staying below that target level. Think about it. We'll see it a little bit later. Targets will give me feedback on my interpretation of the data as well. I may be wrong in my interpretation. Maybe the market had it all priced in. All right. Maybe, so that's those target levels are going to give me feedback. If it goes in one direction off a bearish scenario, let's say, and it can't get below this target level, either the market's going to correct up and lean against another level broken above, or it's going to reverse itself. Okay, but we need to get it through that target levels, or at least those initial target levels, if the market is really going to trend. Okay, and we'll see it again later. Target gives me retracement levels to lean against for a trade after the data is known. And remember, I want to get on a trend, and I also want to define and limit my risk when I get on that trend, because it's important to do both of those things. If you're expecting a bullish or bearish scenario to play out, and that a trend move is going to happen, and trends are fast directional, tend to move larger trading ranges than normal, then you want to be on that trend. You want to take advantage of that quick move, get out on Friday, have a good weekend, come back on Monday, see what happens off of that. But that's what a good trader does. Looks for those trend moves, gets on the trend moves, but you also need to define risk, be able to define risk and limit risk in case you're wrong. And these targets will give you feedback and tell you if you're wrong. Believe me, they will. Okay, so important to map out the targets. So how do I pick the most logical targets? And I use simple technical tools that a lot of traders see and use. This isn't a time to go out and use your proprietary technical tool, folks. That's accumulation of RSI, stochastics, moving averages, CCI, what do you CCI? I don't know, MACD, and put it all together in one big formula, and it's the only thing that the only person that sees it is you. No, don't do that. Be like the rest. Be like the rest. We're all flying blind. We all need to see the targets and react off those targets because we don't know what it's not about being by yourself. It's about being with the market, about everyone seeing the same thing. And you'll be surprised what happens at that point. So finally, we get to the chart. Hey, it's been talking. All right. So what do I use? I use three tools. All right. If you don't pay attention to a 200 bar moving average or 100 bar moving average, I strongly suggest that you do. Okay. Markets tend to react near those levels. Okay. And they provide opportunities. Sometimes they break and they fail, and they break and they consolidate around a moving average, like here. Market trended, it's non-trending. That's okay. That's what happens in markets. They trend, they non-trend, they try to move higher, and they try to break above the 200-hour moving average here, but it can't, and it comes back down, and it tries to go higher again, and it can't move higher, and it comes back down and tests it and tries to go higher again. Well, there's a battle going on here, isn't it? And so if you see this battle after this trend, and you see this battle going on, you're ready to what? Take advantage of a trend, right? You want to take advantage of the trend when it finally breaks and goes below levels. I can draw a trend line right here, and blah, blah, blah. You can see it anyway. So I use 100 and 200. I strongly suggest that you put it in your charts, all right, as a tool. I also use Fibonacci retracements, and I put a Fibonacci from a high to a low. I actually missed the low here, and I missed the high right here. So, but the Fibonacci retracements, and I focus on the 38.2, the 50%, 61.8% retracement. Those become target levels as well, or potential target levels as well. And then I will also So there's the Fibonacci's, okay? I also put in other, if I was looking at this chart and trying to target levels, I would put in other lines or trend lines or highs and lows as other target levels, okay, or potentially target levels. So if you're looking at this chart right here, and we're sitting right here, okay, what might some target levels be to the upside? Well, the 50% retracement of this move to the downside. Is that important? Yeah. Is it that far away from the current market right here? No. It's only about 25 or 30 pips. So in a trend-like move, would I expect that the market would go above the 50% retracement level, or in a bullish scenario? Would I expect the market to go above the 50% retracement? You bet. It better get above that level. If it can't get above that level, then guess what? The market had already priced in. My interpretation of a bullish scenario was totally wrong. That's a huge red flag. So getting above that, even though it's only 25 pips away from the current price, it's still an important level, or a level that we need to target to get above and stay above. Let's say the market went above that level and then moved back down below that 50%. That's giving you, it only goes up 50 pips and then comes back down below that level on a bullish scenario. Are you that bullish? No, I'm not. I'm not. So you have to be prepared. You have to outline these levels. So what's the next level after that? Well, this is close enough to it, but let's go to this high right here. We need to get above that high, right? That would make logical sense to go from here and get above that target. Can you see that? Yes, I can see it. What's the next level? 61.8. Can you see that? Yes, I could see that. These are tools that lots of traders use. Lots of traders will have this on, and they'll target these steps. 1, a 2, a 3. Up here, this 116.39 level, that actually goes back to a monthly chart. But it was another target level on the top side that I had focused on. It was the high from January 22nd is where that. Actually, it's the high from it's near the high right here. Okay, that's where that level comes in. So these highs right here, high right here, high right here. Whenever I see a high, a swing high, and we come up to that level, here's that level right here. Come up to that level and fall off, break and fail above that level, and then reestablish this old high right here. You see how we have a high here, we have a lower high here. So we came down, we retraced here, we fell down, we had this big retracement here, but we found sellers here. That kind of told you something. More sellers were in charge. Now we had some data here that forced the market to the upside. We failed up there and came down and reestablished that line up there. So that becomes a key level. So this area up here becomes a key level, and then the high up here becomes a key level up here. And so those are targets along the way. And if the current price, excuse me, we'll get to that in a second. So when I visually look at a chart before an unemployment report, I'm going 1, 2, 3, big step to here, 4, 5, 6. And as each step goes along, it becomes harder and harder to get up to and through. So there becomes a limit as far as how far you can go. And the distance from here to here is a pretty good distance. I think it's around 100. Let me see here. It's about 190 pips up there. So that's going to be a pretty good run to the upside. I'll talk about that in a little second. So that's our upside. That's our bullish case scenario off a weaker number. What's our downside? Well, we have the 50% retracement. What do we have here? The 100-hour moving average. You need to get below the 100-hour moving average. Again, it's not that far away from the current price, but we need to get below it and stay below it. As long as we get below it and stay below it, that's more bearish. We have this 38.2% retracement, that broken 38.2. We have the 200-hour moving average. We have these lows right here, low here and a low here. Just read the chart from right to left. and we have a low here and a low here. That's it. That's an important level. We came down here, we swung down, we couldn't get below that level, moved higher, came back down to it, found support against that level, moved higher. We have, this cluster of lows here again, a low here and a low here equal, so I got to put the lines in. I got to put those lines in. Then we have these lows right here, a low here and a low here, and that makes another low right there. So those become my targets on the downside. And if you kind of eyeball the distance between here and here and here and here, it's about the same. It's about the same to get to those levels. Below this level would be here, and then we go down to here. These are just steps along the way, targets along the way that you have to follow. Okay, so this is a picture of that. I had another trend line here that wasn't in the last chart. This trend line is parallel to this trend line above here. And so we have 1, 2, 3 different points. We went a little bit below it here, but we reestablished the line right here. You see how we fell below it, kind of consolidation here in off this big move down here, and then we moved higher right there. So I kept the integrity of the line. So on the downside, I have 1, 2, 3, 4, and then 5 and 6 down here. And from this point where the market is down to that level is 174 pips. As I mentioned previously, it's important to understand what is a normal day, what is an abnormal day. It's also important to understand that in a trend-like day, okay, in a trend-like day, it's going to be more than normal, okay, because trends are fast directional and tend to move in larger trading ranges than you expect. So I know from things like I use a 22-day average trading range, which is about a month's worth of trading. If you have 4 weekends in a month, that's 30 days. You take 8 off, and you have okay, I'll finish up in 10 minutes, 5 minutes. Then you have an expectations that the normal day is going to be what is average over the last 22 trading days. And I know that it was about 130 pips. So to get down through the 200-hour moving average here, which is 92 pips from the current level, is that something doable? Yes. So even if you, and where might you expect it to go? Well, at least 130 pips and probably 152 pips. At least to that level, maybe even down to the 174 pip range in a trend-like move. So if you go below the 200-hour move, or if you can sell anywhere in here, now you miss this whole move right here, of course, but remember it's after the event and you're trying to catch the rest of the trend. So if you can sell anywhere in here, in this area right here, you should do it. And where would your stop be? Above the 100. If it goes below the 100-hour moving average, it's only 50 pips away, and comes down here and finds support and moves back up toward that area, this becomes your line in the sand. We should not go above the 100-hour moving average because it's only 50 pips. If it goes above the 100-hour moving average, all bets are off. Something else is happening. All right. Same goes true on the upside. To get above this 79 pips right here, we should get above that 79 pips, and we should stay above that level. That becomes the line in the sand for your stop, okay? So if the 100-bar moving average is your line in the sand, or maybe even this 38.2% retracement, the 79 pip, that's the importance of the targets, because you're going to see a move to the downside, and you're going to see a correction initially. You want to be able to sell against that correction, or on a move to the upside, buy against correction on the top side. That's the importance of doing your homework, because these levels become levels you can lean against to define your risk and limit your risk on the top side or the downside, depending upon which way the market goes. You understand? You target those levels. They become important even if they're broken and you don't get to trade off of them. You're going to be looking for the retracement to the upside after it, okay? So the next step is to interpret the news. Trading steps. So now we're outside the homework. Now we're into the trading steps. You want to interpret the news. Determine if it fits a bullish or bearish trade scenario. Remember, if it doesn't fit your bullish or bearish trade scenario, just wait. That's scenario 3. So if it fits your bullish or bearish trade scenario, go Go for it. Monitor the price action versus the targets, and look to trade against a risk-defining area, one of your target areas. The only way to do this is to have your homework done. So another entry goal of mine is to get in on a correction, 38.2 to 50% of the original directional move. Define and limit your risk. Use to use your predetermined targets. The only way to do this is to do your homework. So what actually happened on the employment day? The numbers came out much stronger than expectations. The revisions were higher. We had the unemployment rate ticked up a pip, but the participation went up strongly, and also the earnings went up. So it fit the bearish scenario. Big revisions, higher than expected non-farm payrolls, participation rate up, wages up 0.5%. The market sold off very sharply initially, okay? And if we go back, these are our levels that we were looking at on the downside. This is a 5-minute chart right here, by the way, but I'm using it as an example. I want to go back here, and I just want to focus or have you look at, you see where the 38.2% retracement is? It's at 113.92, okay? And the 50% retracement is at 114.06, okay? 113.92, our target, 114.06, okay? 113.92, 114.06. Let's go back to our chart. The move to the downside, as soon as we get the chart move to the downside, I know it's a bearish scenario. I want to get in on a correction. We come down about 100 pips to the downside, below that 92. This is our 200-hour moving average line right here. And here's our 1392. Here's our 114.06. This is the 100-hour moving average right here. Oops. Right here. So what do we get? We get the sharp move to the downside. We get the correction up right near the 113.92 level. We have our 100-hour moving average up here. That's our stop. This is the money trade right here. This is what you have to be prepared for. This is what your homework allowed you to get in at. This is what the smart traders are using. They're missing this, but they're getting in right here, or they're getting in right here, or even here with a stop up here, because they know if this is 50 pip, they know that the market has a pretty good chance. This is not betting red or black, folks. This is a pretty good chance that the market is going to stay below that 100-hour moving average. And as long as they can risk this amount, and they also know that a normal trend type move is not going to be 100 pips. It's going to be 130, 150 pips, maybe even 170 pips. And so they're going to be prepared to sell in this region right here with a stop up here. And that is what a smart trader does. That's how a smart trader trades a key event. That's how smart traders make money even after the event without taking on the event risk. And you as a retail trader have to trader, and if you're not doing that, have to become smarter in your trading. If you miss a trade, you miss it. If you don't get in because it only corrects up to here, at least you're ready to anticipate that the market has a potential to move further. We end up going down to around the 113, 11, 11, 10 area on the downside. The next target on the downside, if we go back to our chart, was this low right here, which came in at 113.02. So we held up about 11. This is the day, or we held up about 11 pips or 10 pips short of the 152 pips on the downside. Pretty good day to the downside. Had an opportunity to make about 81 pips after the event without much risk at all on the trade. So that about does it here for me. I appreciate if there's any questions, you can type them in right now. If I have to go, then the FX Street people can let me know. But I hope you learned a little bit about trading key events and releases, understanding that it's about doing your homework. It's about being prepared. It's about understanding your risks. It's about understanding targets in either direction and looking for those trend type moves, because trends are where you're going to make the most amount of money in your trading. So if they type in a chat Do I see are there any questions? How can you contact me? You can contact me. Let me put it in here. And in fact, you can get this PowerPoint. Can you go back before the 5-minute chart, or to the 5-minute chart? Okay. If you want this PowerPoint, just send me an email, and I'll be happy to send it to you. It might not be till the end of the day, so be patient. Okay. Do you have a question regarding that, or do you just want to look at it? Initial move to the downside. Put your Fibonacci retracement. This area right here I call the correction zone. And in a trend-like move, the correction zone should hold the 38.2 to 61.8%. I know there's a lot of people that think that, or 38.2 to 50%. I know there's people that say be patient for the 61.8%. But in a trend-like move, what is a trend-like move? Fast directional tends to move a larger trading range than normal. This isn't the full move. This is just of this bar is bigger than any other bar on this chart, right? So that's a trend-like move. Put your Fibonacci on that. Measure the 38.2 to 50%. Understand that, well, not only do we have the 114.06 level, but we had the 50% retracement level there. We had the 38.2% retracement level here. Those corresponded with those other levels off of our hourly chart. So we had a lot of reasons to think that that was going to hold it in. One back from here. So this one. Or that one. Okay, this one. And again, you can get these slides by just emailing me. I'd be happy to do that. So your goal on entry is get in on the correction, 38.2 to 50% retracement, or to use the predetermined targets to lean against, and make sure that you define and limit your risk, because you can be wrong. Is 100 on the 5-minute. I didn't put it on. Well, here's the 100 right here. This is the 100 bar on the 5-minute chart. It's blue line here. So we move away from that, and you know, once you trend away, you start to use your other tools like the 38 point. That's why I throw the Fibonacci in is because it defines my risk up here. And it takes all day long for the 100 to catch up with the price. Okay, I understand. All right, I'm going to wrap it up. Thank you very much to the people at FX Street, and also people here. Oh, did you? Oh, it's Greg at forexlive.com. You should see it there. To all participants. All right. All right. Thanks a lot, people. Bye-bye now. And thank you to the people at FX Street once again. Bye-bye now.